Have you ever wondered where you can park your cash to earn a decent return without taking big risks? In today's explainer, we're diving into money market funds and money market accounts, two often confused financial tools that might be the unsung heroes of your portfolio. Why do so many investors use them? And what makes them different from a regular savings account or each other? By the end of this video, you'll know how they work, why people invest in them, and how they can play a role in a diversified portfolio, all explained in simple, friendly terms. Let's get started. Money market funds and money market accounts sound similar, and both have money market in their name, but they are actually quite different. Think of it this way. One is an investment fund and the other is a special bank account. Both are popular places to stash cash because they offer higher interest than typical checking or savings accounts and easy access to your money. But the similarities mostly end with the name. Money market accounts, MMAs. These are deposit accounts offered by banks or credit unions, sort of a hybrid between a checking and savings account. They pay you interest on your deposits, often at higher rates than regular savings accounts, and they usually let you write a few checks or use a debit card. Crucially, MMAs are federally insured up to $250,000, so even if the bank fails, your money is protected. In short, a money market account is a safe, liquid account for your cash that also earns interest. Money market funds, MMFs. These are mutual funds typically offered by brokerages or investment companies. When you put money in a money market fund, it gets pooled with money from other investors, and the fund manager uses it to buy high-quality, short-term debt things like U.S. Treasury bills, commercial paper, and certificates of deposit. The goal is to earn interest from those investments. Money market funds are designed to be very low risk and highly liquid, and they try to keep the share price at a stable $1. However, they are not bank accounts and not FDIC insured. Their safety comes from the quality of investments they hold. If you've ever had a savings account, a money market account will feel very familiar. You deposit money at your bank, and the bank pays you interest. The cool part is that MMAs often come with check writing or debit card privileges, so you can spend or withdraw money directly. MMAs also come in handy for people who want to keep their cash within a bank but still want it to work a little harder. While the yields can fluctuate, they are usually more competitive than standard savings accounts. And because they are insured, even cautious investors feel confident storing larger sums here for near-term goals. Imagine you have cash sitting in your brokerage account. Instead of earning nothing, you could put it into a money market fund to earn interest. Money market funds buy short-term, high-quality securities and pass that interest on to investors. Money market accounts are bank deposit products insured and accessible via ATM or check. Money market funds are investment products not insured, but offer higher yields and are very liquid. MMAs have fixed interest rates set by banks. MMFs have floating yields based on market conditions. MMAs are great for emergencies or savings. MFs are ideal for cash management in portfolios. Both types of money market investments play an important role in diversification. They add safety, liquidity, and income to a portfolio. Money market accounts provide a cushion in case of emergencies. Money market funds offer flexibility and a place to earn yield while waiting for better investment opportunities. Money market yields follow interest rate trends. In the early 1980s, they offered double-digit returns during high inflation. In contrast, after the 2008 financial crisis and during the 2020 pandemic, rates dropped to near zero. As rates rose again in 2022 to 23, money market funds and accounts saw yields spike, drawing record inflows from bank deposits. They've proven to be reliable during market downturns, acting as safe havens for both individual investors and large institutions. In fact, some of the largest money market funds now hold over $1 trillion each, reflecting investor confidence in these vehicles. There have been rare moments, such as during the 2008 financial crisis, where one money market fund broke the buck, meaning its share price fell below $1. While unsettling, regulatory reforms since then have made funds even safer. New rules ensure greater liquidity and higher quality holdings, minimizing the risk of such events repeating. Conservative investors who want a stable, low-risk investment. Retirees needing income and safety for short-term spending. Short-term savers working toward a near-term goal. People with large cash balances who want to earn more than 0%. Investors seeking a safe haven in volatile markets. Anyone who wants a reliable, low-risk portion in a diversified portfolio. If you're investing for the long term and have a high risk tolerance, You might keep your money mostly in stocks and limit your use of money market products, but for most people, they're a smart addition that brings balance, flexibility, and peace of mind. Money market funds and money market accounts are all about giving your cash a job to do, earning interest while keeping it safe and accessible. They serve as the calm, steady ship in your financial fleet. Money market accounts are perfect for emergency savings and short-term goals, while money market funds offer slightly higher yields for strategic cash management. In uncertain times or rising rate environments, these tools become even more valuable. They may not be flashy, but they're dependable. And in the world of personal finance, that's something worth celebrating. Thanks for watching. If you found this explainer helpful, don't forget to like and subscribe for more insights into managing your money wisely. Drop your questions in the comments below. Until next time, happy saving and investing.